Talk about an economy that navigates growth in a challenging environment. Nigeria fits into that category. And here at the Afrinvest 2014 Nigerian Banking Report, this was the focus. In his opening remarks, the Vice Chairman of Afrinvest, Mr. Godwin Obaseki, spoke about the reports that Afrinvest has been doing since 2005 and its impact on the Nigerian economy, and also speaking on the CBN regulatory reforms and what's the way forward in terms of engagement with the banks.
As you all may know, Afrinvest is a leading independent investment banking firm with a focus on West Africa and has four principal businesses, which include investment banking, securities brokerage, investment management, and investment research. Over the last 2 decades, Afrinvest has distinguished itself as a highly innovative firm, pioneering a number of groundbreaking investment banking transactions in the Nigerian marketplace.
As part of the event, Mr. Bismark Rewane, notable Nigerian financial analyst and CEO of Financial Derivatives, gave an overview of the Nigerian macroeconomic environment.
Commodity dependent, problem here is that a 20% fall in oil price will leave the deficit at 3% of GDP, but it also leaves the external sector extremely vulnerable in terms of its oil earnings. And I'll come back to that in a minute. Tax reform, deep tax base, but taxes are not collected and they are arbitrary, and it's very regressive in the sense that the poor and the rich pay the same kind of tax burden. In any case, it's a benefit approach tax rather than the ability to pay tax. Capital expenditure, no defined. I tell you what, Kenya is spending 8% of GDP on capital expenditure. China spent 15% of its GDP for 15 years on infrastructure. The emerging market average for infrastructure is 6% of its GDP. Nigeria is nowhere near that. Nigeria is about 1 or 2% of its GDP on infrastructure every year. That's why the gap is widening. And the difference between development and growth is that development has both institutional and physical infrastructure at a high level, and that becomes the basis on which growth is going to move.
Highlight of the event was the unveiling of the Afrinvest 2014 Nigerian Banking Report by dignitaries that attended the event.
Yes, I am just going to count down by mentioning, just actually listing the alphabets, the bank, B, A, and K. As I say, B, A, N, K. Now you have it. Please help yourselves to a copy each, and please hold it up for the media. If you hold it up a little, just right. Thank you. Please, yes.
Mr. Chioke, the CEO of Afrinvest, also spoke about the banking report, its overview, speaking to the key sectors and the total performance of the various tiers of the banks in the country.
That presentation is in 4 sections, just kind of highlighting that the growth is ebbing away from the industry. And then we'll go quickly into the sector performance, and talk about valuation implications, and end with the main point of banks for the economy. Where are the loans going? Growth has been slowing in recent years. You've seen the industry grow from 1.5 trillion of gross earnings in 2009 to 2.8 trillion. But you can see that the change from 2010, coming out of a low base of a weakening sector, was 50%, then 34%, and now 2012 to 2013, only 12%. The cumulative average growth rate for the last 5 years is still looking good at 117, but we are seeing that the industry is struggling to get growth. When you look at profit before tax, we see growth is mixed, somewhat driven by accounting changes. It was 278 billion in 2009, up 365 2010, down 147. Again, 2011 was the top year. 580 billion 2012 and 521 2013. You can see the ups and down gyration. Well, actually, when you point to 2012, most of that growth is actually supported by accounting policy effect, because when you saw the change from Nigerian GAAP to IFRS, you saw the banks would claw back quite a lot of impairment charges. They will have put in about 220 billion naira there, which also will trickle down to the numbers we're seeing.
He further spoke on the banking report and various issues that are pertinent to the economy which needs to be tackled.
Well, I think the industry is competitive enough. I do think that 16 banks overall, and those are actually, no, it's not 16, it's 15 banks who are publicly traded banks. It's quite a large number of banks for Nigeria. In many large economies, you may see there are 3 or 4 really large banks that control maybe 80–90% of the industry, and then very small specialized banks that focus on niches. So I think the industry is significantly competitive and open. But what you do find that when you're a large bank with a bigger capacity, you have certain economies of scale. First one is probably that your cost of funds goes down. Yeah? And once your cost of funds goes down, then your capacity to lend at a lower rate of interest is stronger. If you can lend at a lower rate of interest and still make a decent profit, you become more competitive. So somebody who wants to borrow, you will not go and borrow from a bank that wants to lend you money at 25% when another bank wants to lend you perhaps at 15%. You see what I mean? So the advantage of being big scale is that you have cheaper cost of funds, typically, and with cheaper cost of funds, you're more competitive in your lending program, and then therefore you can then further increase your market share. What our data is showing to the mid-tier banks is that they need to find ways to be either far more efficient, more nimble, and maybe use technology to optimize their system, or otherwise find a way to grow and get bigger, and therefore the operational cost will reduce as a percentage of the overall turnover.
Nigeria has gone through various challenges, from insecurity to the challenges of policy and even the issue of institutional framework. But one thing remains, that in its quest to become a strong economy, robust and to be aligned and relied on in the country and across the world, it must navigate through the challenging environment it faces. And this calls for more partnership and more coordination between public and private institutions, especially in the banking sector.